Hey traders, welcome to Charts and Coffee. Great to see everyone. Happy Tuesday. We are continuing to sort of meander down this road of the last week of August where we have ridiculously low volume, probably some of the lowest volume that we see throughout the year, actually quite a bit lower than what we see leading up into the Christmas holiday, and then also the New Year's Day, right? We have these different windows. This is probably one of the most illiquid times of year, which makes it tricky because without participation, there's very little follow through. And without attention, there's very few sustainable breakouts, which all leads to it's very difficult to get follow through. And even I would say this week, if anything, if we've got opportunity, and there might be plenty, because what we lack in volume at the moment, we will more than make up with data. Think about this last month. Some folks are on vacation, a lot of apathy in the market just because folks are just not concerned with the end of summer trading. And yet we have GDP, PCE, JOLTS, and non-farm payroll in the next 4 days. Right. So they will have to come back whether they like it or not. We will have little explosions of attention and volume. And yet we're still going to deal with this potential lack of follow through, which is not a new theme. It's not a theme limited to this last week or two of August. It's going to be the theme going into September. And why would I say that? I'm not going to say it's going to be this tough because the volume will come back and follow through will be a little bit better. But then what's the next obstacle? If the obstacle right now, the thing in our way is the low volume leading to a lack of follow through, well then, Raghee, the volume's back in September. Don't we just get back to July type trading? Unfortunately, no. What we're going to end up with is trading that continues to be really good for us in terms of opportunity, but we've got to shorten the time frame. Because if the macroeconomic clouds of what is Powell and company, what are they going to do? That still lingers, while there won't be a reason to be nervous because of it's the end of summer type reasons. We have to remember that then the macroeconomic. So what we don't want to do is miss out on where the opportunities are. That's going to continue to be short term. All right, there's two buckets there. Short term swings, 1 to 3 days. And today, right? Day trading, today trading. I wish they'd call it today trading. Maybe we need to change that. What is happening today, right? And then start with a fresh page, fresh set of eyes the very next day. All right, so that's the breakdown, gang. And as always, if you have any questions, feel free to type them on in. What symbols are you looking at? What time frames are you looking at? You know, what's on your mind? What right now is keeping you from turning the corner? Okay, Rog, this is one of my struggles. Yesterday, we had a question about, you know, what happens when I'm a few years into my trading? I think I got this late in yesterday's show and I didn't have time to address it. One of the questions was, what happens if I'm a few years into my trading and I'm still kind of getting to the point where I can turn the corner? One of the challenges with that is really two. One of the challenges with that is really looking at what is working, because something's still working. It may not work as well as we want, but something is working. Do we have the confidence to go all in on that from time to time? So for example, do I have the confidence between now and November 1st? And why November 1st? That's the next meeting where we could see some FOMC movement. Between now and November 1st, do I have the confidence to just kind of go mostly, not completely, but mostly all in on day trading as I'm waiting for the clarity to develop? That's a really scary prospect for most traders, because they say, well, what about all these other styles that I like? And we have to ask ourselves, are those styles appropriate for this time of this macroeconomic cycle, for this time of year, for the current trends, right? So those are always difficult things. And if we can be really frank about that, well, then we have a prayer. And then the second part, right? Trade what we see, not what we think. That would be the first thing. The second thing is, do I have a repeatable risk management strategy? And I mean spreadsheetable. What do I mean by that? Is it something as formulaic as I can type in certain numbers and work a repeatable risk management? And those are usually the two things that when I've been working with traders over the last, it's been a long time, crazy to even think about the number of years, but when I think about it, those are the two things that most traders are having trouble with. And they're actually pretty simple to fix mechanically, but they're really hard to fix mentally, right? So with that in mind, Stephen asked, could I give us a preview of the webinar on Wednesday during my 20-minute show, Stephen? I'll tell you what we're going to talk about. I'm going to talk about how I've been trading in August, because who cares what happened in July? July was a mirage, right? So I'm going to talk about August. I'm going to talk about why August is likely sort of the template, right? August movement is probably the template for what we're going to see going forward. And I'm going to share with you the data as to why that's the case, right? I'll do it a little bit right now, Stephen. And I think a lot of you probably already know. We're going to get a pause in September. So there's nothing really to fret about macroeconomically. But November 1, you can see that the quarter point hike is starting to factor in, which means this is where there could be some uncertainty. Where there's uncertainty, there's a lack of follow through. Where there's fear, there's a lack of follow through. So that's why the short term is going to continue to work because of this. This is all rooted in data, right? This is never I think or I feel, right? This is not Dear Diary. The market is being so mean to me. No, this is journaling what the data, what the rate of change is telling us we need to focus on. And the other part of the webinar, aside from the macroeconomics that are going to continue to drive us, is what have I been doing in August? I'm going to share with you the trades from my room, right? I'm going to share with you what we've been doing in the membership, the good and the bad. So yesterday, great example. Yesterday, I had two small trades. I had two small losses. I love talking about losses more than wins. The reason I like talking about losses is the better we're a good loser, the more we have a formulaic approach to loss. I've never blown up an account, ever, because from a mathematical standpoint, position sizing and exposure, it actually would be almost impossible. I'm not saying it would be impossible. If aliens were hovering over Manhattan, there's going to be limit moves, there's going to be gaps. But barring that, barring alien spacecraft hovering over Manhattan, I don't ever fear that because I'm position sizing in a certain way. So those are things that we'll touch base on Wednesday. I'll talk about edge, right? There's three things that really work in my trading. Scalability. How do we have a scalable approach? That goes back to a formulaic approach of risk management and position sizing. And the other part is what's your edge, right? Time of day is one type of edge. How do I trade the afternoon versus morning session? And the other edge is how am I seeing levels that give me clear opportunity, right? And so that's a lot of what we're going to talk about on Wednesday, Stephen. And of course, tons of examples, right? Because if these aren't trades that I'm sharing with my members, and if these aren't trades that I'm taking, who cares, right? I'm always a fan of whenever I'm having a conversation about analysis, I'm just talking my book because there's nothing else to talk about, right? Okay, what about the ES on a 5-minute chart? Yeah, let's dive into it. Mr. Walker, if I'm looking at the S&P, here's things to really remember, and this is a huge, huge difference between what most traders do and what we do in the mastery. First of all, the S&P is not the place I'm looking at for clarity on the day. Most traders, they are going to focus on the S&P and usually only the S&P, and that's okay. I'm going to talk about what I do. I'm going to talk my book. I'm going to talk about things that I am doing with the members out loud, transparently. The S&P is the last index we need to look at. Why? Because if you look at the S&P weighting, this is the sector secret, XLK, XLF, XLV, tech, financials, healthcare. Well, tech is going to have it move a lot like the NASDAQ, right? So first thing I want to do in the morning is start off with what the heck's the NASDAQ doing, right? What is this thing doing? What are the sectors within it doing? And then I'm going to move on, not to the S&P, I'm going to move on to the Dow, weighted with financials, tech, and healthcare. In a different order, that's the S&P. I need to figure out what the Dow is doing. Sometimes the Dow will do something very, very differently than the NASDAQ, right? One of the other reasons, so Mr. Walker's asking about a 5-minute time frame. This is day trading, gang. This is day trading. Day trading is where I can control risk. Day trading is where I can keep my pipeline of opportunity full. And day trading is where I can find morning and afternoon setups. So again, keeping that pipeline full. So day trading is what? It's a way of controlling risk. But the first step is, what do I want to day trade? So Mr. Walker, it may not be the ES, right? I need to figure out what the NASDAQ's doing, what the S&P is doing, only after I see which one, the NASDAQ or the Dow, are leading the or sort of taking the S&P on the route that it's going to go. S&P is never the captain of its own ship. Then we could break it down to sectors. Then we can break it down to individual stocks. And my favorite way of day trading is the most accessible way of day trading. We're going to day trade options on the ETFs, options on stocks, which means all the indices are liquid and accessible. All of the, crude, gold, silver, treasuries, right? And I'm sure even some of the commodities like wheat and corn, but all of these are accessible through much more affordable ETF options, right? So it makes it very, very simple and lower leverage to trade. And also, like I said, the scalability. Someone with a small account could trade SPY options. Someone with a large account could trade SPY options. That's scalability. So that 5-minute chart is going to open up a lot of possibility for a lot of different types of traders. But I would say start with NAS and the Dow first. Get a read on those two, then go to the S&P. That alone, Mr. Walker, that alone is going to be more helpful than my telling you, we need to do this on the S&P, and this is the read, and this is the pattern. Start with that process. Your S&P trading will immediately improve, right? And those are the kind of things that they're subtle, and a lot of times they don't follow the typical dogma of trading. But those are the nuances, right? That'll make the difference. Hey there, Michael. First time? All right. Great to see you. Welcome, welcome. All right. Penelope asked, when looking at a chart like the QQQ or SPY, sure, do we take into consideration new high or new low during after hours trading, or just look at the high and low from the previous session? So remember something about after hours, Penelope, whether that be QQQ or NQ. There's still lower volume and participation than what we'll see after 9:30 Eastern. So whatever I see at 2 a.m. with the European Open, whatever I see with 2 a.m., 7 a.m. Eastern with sort of the early U.S. session, those are going to be far lower in volume, far lower in attention than what happens after 9:30 once the Wall Street bell rings, right? So while those highs and lows can be interesting, the volume occurring at those highs and lows is far more interesting. If there was data released out of the European or UK session and those were the wicks, that's much more helpful. But I would say once we start trading the US, the North American Open, the previous session close is going to be far more important. And there are a few other reads that I'll take, but that's a really simple one that, again, just that one idea of am I up or down from yesterday is an absolute needle mover of a concept. And when you start adding in all these little ideas that give us insight into sentiment, momentum, and trend, all these little simple things that are sort of hiding in plain sight, when you add those in, that's where you turn the corner. It's not some big idea. It's usually little ideas like that. Oh, can I measure support and resistance, which everyone does, with volatility instead of price? Little idea, big change, right? Just a slight shift like that. And those are the kind of things we'll definitely talk about tomorrow. Hey, gang, by the way, it's coming up tomorrow. So if you haven't registered, I'd hate for you to miss it. You don't want to miss out. When we're done with this conversation on Wednesday, you're going to have a lot of these little ideas to put to work on Thursday. That's the way, Trish and I put a webinar together. Can we drop little ideas that will immediately make a difference in what you're doing? So that's tomorrow, simplertrading.com/consistent. All right. Next up is, what do I think about a Friday Amazon slightly bearish? Rainy days. It's Tuesday. Are you asking me about Friday? When my flux capacitor equipped DeLorean is back, my friend, I'll be able to tell you. Yeah, not a clue. Let's just get through Tuesday, right? We've got non-farm payroll on Friday. We've got PCE data and GDP. So I couldn't even begin. And by the way, rainy days, that's just me saying, I don't know where Friday is going to be. Nobody knows, right? Nobody knows. Nobody knows. So let's think about what's the trend right now? What's the probability? All right, what's the best way to start a day with what is the best way to start the day with a neutral bias? Tech Trader Joe, what's the best way? Day trade, right? If you want to start every day with a fresh set of eyes, don't have baggage from the day before. It is impossible to have a long position or a short position that's overnight, right? It is impossible. So if you're asking what the best day it is to sort of say, I don't care what today brings, I'm going to trade what I see, not what I think. Day trading, absolutely. And the freedom in that is every single day, I can start my day off with, I'm not a bull, I'm not a bear, I'm a capitalist. Right. And I'm going to trade what I see, not what I think. So if you're looking to get that much more neutral, if I know my father was not Spock, I'm pretty sure Tech Trader Joe, your father wasn't Spock either. Right. So I'm going to have emotion. We're all going to have emotion. To reduce the emotion, a lot of times the best way to do that is an empty page, is a flat book of trades, nothing. Right. Now, there are times when it is important to have bias, but under the cloud of we don't know what Powell's going to do, I'm with you. We want to be neutral every single day. Absolutely. I agree. All right. Next up is, let's see here. Would I comment on the dollar? Would I comment on the dollar? Sure. If we're going to talk about the dollar, Russ, we need to talk about the euro. Now, not most traders are going to tell you that look at the euro, not the US dollar, not the UUP, not the DXY, not the DX. That is a basket, right? So coming from the hard knocks of over 20 years of Forex trading, I will tell you the correlation between the euro, the single currency, and the dollar is 90+%. I think it's a 95 or 96% negative or inverse correlation, which means if the dollar zigs, the euro zags. They move almost completely opposite. And the reason for that is two things. One, the most popular symbol of any kind of any market on the planet Earth is the euro versus US dollar in the spot or Forex market. So that's a big part of why they move inverse to one another. The next part is when we look at the US dollar basket, DX, UUP, DXY, 58% of that basket is the euro. So if you want to know what the dollar is doing, look at the euro. Not to mention, lastly, the 6E is far more accessible, a futures contract to track than the DX. The DX would require the ICE, the Intercontinental Exchange. 6E is on the Chicago Mercantile Exchange, which for most of you, like myself, if you're on TOS or Tasty or TradeStation, heck, even on TradingView, it's much more easy to gain access to it. It's much lower cost because let's face it, exchange fees are a thing. I'm not sure that we have clarity enough on the euro yet to say that I'm a euro bull or a euro bear from the current level. But overall, I am more bullish to euro. I just need a buy setup. I'm not bullish the dollar because we're at the tail end of a tightening cycle. So as soon as we get, and again, this goes right back to that macroeconomic murkiness. If I don't know if Powell's going to hike one more time, hiking by a central bank is bullish to that country's currency, which is why the US dollar just won't fall because there's just this what if we get another quarter point hike. But after that, the European Central Bank, the other side of this pair, the European Central Bank is still within their hiking cycle. So at some point, the euro will start to gain strength, gain traction on the dollar, if for no other reason than the US Central Bank has gone neutral, while the European Central Bank is still hawkish. And those are things that we need to for sure understand. I don't know that they're great. I don't know that they're great necessarily setups yet, but they are the way we want to measure. They are the way we want to measure what's going on in this current environment, right? And that's the reality of central banks are the macro. Macro is not headlines. Macro is not even earnings, gang. Fundamentals and macroeconomics are not the same thing. Jobs and inflation. The U.S. Central Bank has a dual mandate. Any data that suggests the trend in inflation, which we're going to get this week with the PCE, and any data that suggests a trend in employment, whether that be employment, unemployment, job openings, we're going to get all three this week, right? That's going to dictate what Powell and company are going to do and say going forward. So huge week in terms of data. And gang, just like that, time is up. I'll see you all tomorrow. Same time, same station. Be good to each other. Watch the economic calendar. Caffeinate and dominate, my friends. And again, if you haven't yet, tomorrow at 8, you don't want to miss this. All right. How is the risk going to be managed in an environment like this? How are we going to keep our pipeline of trades full in an environment like this? When, by the way, could we start to see action like July? I've got a timeline potentially for that too. So again, join us tomorrow, simplertrading.com/consistent. I'll see you then. Be good to each other, gang.